Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to dealcatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to our latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is David Robbins, Director at StepStone. David's formerly with Neuberger Berman and a 20-year vet of this industry. So, David, it's a pleasure to see you and at least meet you virtually here. Thank you for the time. Looking forward to the episode.
Well, Todd, thank you for having me. I appreciate the opportunity to speak with you today.
And just for those who might not be as familiar with StepStone, maybe just give us a quick 30, 60 seconds. Who are StepStone and kind of where do you guys fit within the broader markets?
Absolutely. So StepStone is a publicly traded on the NASDAQ asset manager. Today, our responsibility is about 811 billion, of which about 78 billion falls into the private debt wheelhouse. We have about 95 investment professionals spread out globally, committing, call it 12 billion on an annual basis.
So, a lot of our conversation is going to revolve around some of what's been going on in the news. And there's clearly been some jitters, at least the news media has certainly gotten some jitters. And certainly investors, we've seen some news with some of the big brands in the space around private credit, direct lending, in particular the last year. Maybe just give us a little bit of a review of kind of how we've gotten here, say the last 12 months.
Todd, it's a great question. And maybe jitters isn't the right word, but we'll say headlines because there's certainly been a lot of that. And I don't even know if we have to go back 12 months. It really started August, September of last year with the combination of Tricolor and First Brands. Both were really victims of fraud. Those were the real drivers there, but caught a lot of headline attention because there was some private credit exposure, for these companies. Now, an example, though, of how the media really exasperated what was going on, some portfolios had less than 1% impact from these respective holdings. And that comes back to the fact that private credit is an area that when you invest, it's in a diversified manner.
So, if we look at beyond fraud, and if we put that aside, there's certainly been investor pressures on the market. There's been some of the big brands have had to give higher than normal, redemptions to investors. And so is it more of a case of, liquidity, valuation, broader economic pressures? Now we have, obviously a conflict to deal with. Is the private credit direct lending market starting to feel some pressures within itself beyond the fraud? What are maybe some of the drivers around why investors might be looking to pull their money out of whatever the fund might be?
Todd, whether you're talking about private credit or you're talking about one of your favorite sports teams, whenever you're enjoying any level of success, there tends to be a lot of eyeballs on you. Private credit as an asset class has grown tremendously. Uh, some would use COVID as the timestamp. Some would go farther back than that. Um, so the growth in the asset class was already bringing itself a lot of scrutiny. There were no cracks. There were very few defaults. If anything, defaults are on the decline from all-time highs, which were minimal at best. And, you know, people were looking for something that wasn't really there. The media has sensationalized what really happened with some of the larger asset managers in the space in terms of people getting their redemptions. But people were asking for their redemptions because they were misinformed about really what was happening with their investments.
So if we look at the market structurally, is it sound? Is the institutional piece of the market, the retail piece of the market? Um, is there just some rebalancing going on overall in the market? Maybe some funds and some overweight towards one sector. Like, is the market structurally sound to where it is today?
At StepStone, we would say it is. There's always going to be some bad actors, but you know, when it comes down to it, underwriting is really what's going to make the difference in the long run. And underwriting continues to be very stringent. And, we saw that when liquidity was needed in these recent weeks. No one underwrites more stringently than some of these institutional investors. And, they basically were taking some loans off the market at close to par.
I mean, can some of this be traced to there's a bigger push by the market to reach the retail investor? There was obviously an announcement by the administration earlier in the year for the 401ks, like bringing private markets greater access to retail investors. And is some of this just the natural, if retail money is coming in, then the scrutiny on it's just going to increase overall, and that might play into some of this, even though there's a lot of fundamentals that are strong in the overall market.
So you brought up a couple of things there. So let me unpack that a little bit.
Yep.
The first is the SEC's role is to scrutinize anything, big or small, that the retail investor may be seeking to get exposure to. And when you have and I'm going to limit my comment to really the BDC and the interval evergreen fund space. Anytime you have $200 billion plus and over 300 offerings to choose from, that's going to capture the attention of the SEC.
Mhm.
And as far as the landscape changing to adopt, I mean, the fact of the matter is banks have been lending less, from where we were, call it 5, 10 years ago. So someone had to step in. And that's where private credit happily stepped in. It's no coincidence that several managers have grown 10, 20x in their AUM. And it's not because they just created this business out of thin air. There's a direct correlation in the decline of lending that banks were doing, or I should rephrase that, willing to do,
Yeah.
and the growth of private credit. And, as public markets have, one, become more concentrated, you went from north of 8,000 publicly traded companies 20 years ago to a number half that.
Yeah.
you know, True diversification for the retail investor you have to go outside the public markets. And furthermore, in 2022, we really learned how correlated the public markets have become. So the retail investor really needed the private markets to weather market volatility with true diversification.
So, in your view, the concept of semi-liquid private credit, is that appropriate for retail audiences? Is there a misunderstanding of the risks?
So I certainly think it's appropriate. What I think that people struggle with is fully understanding what they're invested in and the timing of those investments. Um, from a risk standpoint, what a lot of people don't necessarily appreciate, and I'll stick with private credit, is that private credit, while its return is significantly higher than debt vehicles in the public market,
Mhm.
whether it be investment grade bonds, senior loans, or even high yield, the volatility that comes along with private credit is half of any of those vehicles, if not even less volatile.
So when it comes to the financial advisor, recommending potential options to individual investors, um, how would you say they should approach this, especially maybe a time where they're starting to see some of these headlines come out, and it's clearly giving them further questions from their investors of, hey, what's going on in the market? What's happening here? How would you say financial advisors should approach a market like this when it's kind of at this point that certainly is making it feel as if it's a lot riskier than maybe it is?
No, absolutely. And maybe I should expand on my previous response a little bit and add some numbers to it before I go any further.
Sure.
So from a volatility standpoint, private credit has an annual volatility of about 3.5 compared to senior loans just north of 9, investment grade at around 6.5, and high yield over 10. So there you have it by the numbers, significantly more volatile. Now, the trade is the lockup, and that lockup can vary anywhere from quarter to quarter to several years, depending on the vehicle.
Yeah.
So the financial advisor really has to know their client and know their client from a risk standpoint. Are they a client that any time that the markets move more than 1%, they're almost guaranteed a call at 4 o'clock? Or is it a client that has shorter term ambitions, whether it be the purchase of a home or significant withdrawals? Because private credit has continued to do exactly what people had planned on. But the reason that people get paid the way that they do in private credit is that limited liquidity that they have.
So when it comes to some of the critiques, obviously we touched on it a little bit at the top with the headlines versus maybe what's really happening in the market. But there has been some advocacy groups saying retail investors in private markets can be exposed to unfair risk. Obviously, the headlines have. I watch the financial news when I'm in my office, and there's been a lot of private credit firms on the TV today. Certainly, getting the word out about the market, but I guess how fair are some of the critiques, especially when it comes for advocacy groups looking to protect retail investors versus some of the headlines.
Yeah. So, I'm not one to make a career of defending our friendly competitors, but I will tell you, you know, those asset managers that have been in the headlines have exceeded investor expectations, and they've done so in a way that was more than fair. So, without naming names, we'll use one example where a significant amount of capital was needed. Now, the easy thing for the asset manager to do would be to look at their portfolio cherry pick the best assets and try to get the best price that they could in order to raise capital to meet the redemptions requested. That would have been the easy thing, but that's not what they did. They actually um, took a pro rata allocation across their book and sold to an institutional investor almost at par. And when I say almost at par, 99.7, that's as close to par as you're going to get. um, and allocated that. So I think that they were more than fair to the retail investor, though the media claimed that they sold the best assets and left the retail investor with some questionable assets. Another example that's been in the headlines was a fund that, allowed for up to 5% withdrawals, and they receive requests for more than that. And they met that request. They didn't gate their fund. They met that request. They got creative to do it, but they met the request. And it's another example of, how these funds have really thought through the liquidity needs that they have and have planned for worst case scenarios.
When it comes to some of the other things that have recently at least come up in the news cycle, concentration risk is clearly one of them. And as people were saying, I think a couple weeks ago, I had someone on the show that mentioned, I think it was SaaSpocalypse, which I think was a little funny, but
Yeah.
clearly it's beyond just concentration in a sector, but it can also be concentration in managers or manager. And so maybe talk a little bit about the concentration risk and, making sure you're diversified beyond just sector, but, could be strategy or manager as well when you're an investor moving into this market.
Yeah. So let me start with the strategy, and then we can talk more specifically from a portfolio standpoint. So for years now, in the retail space, and I don't love the term retail space because someone could have $25 million to their name, and I don't really consider them a retail investor.
Yeah.
I like to call it private wealth. And they've been talking about investing like institutions, with a higher exposure to private markets. And the numbers have continued to grow up as that has become more accessible through some of these vehicles. You see some private wealth individuals investing north of 30% of their portfolio, even though the industry average is 8% and rising. The challenge is that they only take half of the advice when it comes to investing like institutions. Institutions give the portfolio significant exposure to private markets, sometimes north of 40%. But the part that I think gets lost when translating that to private wealth is the number of strategies that you use to get that exposure. And it's not passed on. So using the example of private credit, someone might have meaningful exposure not only to the asset class, but they might have it with one manager. That's an
Yeah.
unintended risk that they've taken on, not because the manager necessarily has done something wrong, but if something were to go wrong, it would just create an exponential impact on the portfolio. Now, taking it to the portfolio level, and this was something that really came to light back in the fall when First Brands and Tricolor were in the news, and that has to do with portfolio concentration. So in most areas of investing, if you have high conviction in a particular idea, you might increase your exposure. In credit, though, there's no upside. The best case scenario you have in private credit is that you get your money back and you get your coupon along the way.
Yeah.
So having a higher conviction position in private credit is a zero-sum game. And what we learned in the events in the fall is that several managers have 2, 3, even 5% exposure to an individual company, which from our perspective doesn't make any sense in this asset class. And furthermore, with some of the larger strategies in the private credit space, they're all buying, or several of them are buying the same stuff. So you may think you're getting diversification by having two distinctly different asset managers in the private credit space, but you then find out that the number one holding in one portfolio is the number three holding in another portfolio. And on top of that, they're significant holdings. Our approach across all asset classes is really about diversification. But in the private credit space, we try not to let any one position make up more than 1% of the portfolio.
To to what extent do you think some of the macro conditions, obviously we now have a war that is playing out. There's been obviously the AI disruption among software. Um, do you think some of these things can start to get conflated? Like private credits obviously had some headlines, then you'll have the macro headlines, and then all of a sudden it feels like private credit's going further and further down, when in reality it's a bit of a natural rebalancing given some of the macro things and some of the things we've been talking about here for the last 20, 30 minutes.
Yeah, I mean, look, private credit and more broadly, private markets got a bad rap with the media over the last few weeks. Uh, it was not specific to any one company. Everyone's stock price that was publicly traded had a pretty good beating, and some more than others, and for no particular reason. You had some people that were, or I should say, some firms that were, at the center of what was going on in the media, and they, might have had an initial impact to their stock price, but not much further. And then you've had others that continue to experience volatility, but yet month after month, quarter after quarter, they deliver for not only their clients and their portfolios, but to their shareholders. As recently as yesterday, Barclays reaffirmed several of its ratings on private asset managers.
So it does feel like it's kind of two different stories being told. Kind of the the actual investor story, which is still seeing strength
Absolutely.
when they look at their reports and look at their statements, and then some of obviously what's been going on in the news that has kind of thrown the space into a little, I wouldn't say a tailspin, but a little bit of a flurry the last few weeks that has certainly got people on a little bit of the defensive. And in some ways, I would think it could be good for the market that people are out there talking about private credit more, and they're kind of taking care of some of these misnomers. But things can take on a life of their own too, so it's a delicate balance.
I mean, Todd, when I say this, I speak for myself, I speak for all of my friendly competitors. We have all spent too much time on something from an investment standpoint was a non-event. But yet we spent a lot of time explaining the miscommunication that was happening about the asset class as well as our competitor funds, just because people were concerned about contagion. I mean,
Yeah.
I'm happy to share, uh, the Q1 26 numbers aren't finalized, but the redemption rate at StepStone was significantly less than 1%. in Q4 of last year. That to me doesn't seem like contagion. That to
Yeah.
me seems like idiosyncratic events that have been magnified by the media that then cause misinformed people to redeem or rebalance, depending on kind of where their individual circumstances had them.
You obviously before you had mentioned the term retail versus, private wealth. Um, if we do get to a point where 401ks are investing in some of these assets, is this kind of a good practice run for what could be further scrutiny on seemingly what's going to be coming down the pike? Because obviously there'll be a lot more investors who are certainly not going to be as well informed about what they're investing in based on what they typically have seen in their 401ks and what has been available to them up to this point.
Todd, I mean, that right there is a perfect example of the media and what they're communicating because the practice run, as far as we're concerned, has already begun. It began when the current administration uh, loosened the requirements in order to invest in these current vehicles outside of the 401k. So currently, there is no uh, investable net worth requirement to invest in some of these vehicles. It is then assumed that they're used appropriately. And that's why, a lot of times when we're out there educating advisors and helping them paint the picture of a suitable client when it comes to private credit, we'll often suggest starting with their retirement dollars because these are dollars that unless extreme circumstances come about, they really can't touch until they're of retirement age anyways. It
Yeah.
helps to reduce the temptation.
With just a few minutes left, we have some fun questions. But one last question, I guess, is there anything that that does give you a little pause about the market overall from a structural standpoint, macro standpoint, as we go into Q2, Q3, Q4 in 2026, in private credit?
You know, from a from an underlying fundamentals of the market, I think the market's in a great place. Uh, I don't think that anyone is looking to do harm. What causes me to pause is advisors and investors fully understanding what they own
Yeah.
and how those things may overlap or how those vehicles are structured because I don't know that that is always the case. And that's why, myself and my colleagues at StepStone spend so much time on education. And we'll sometimes be asked, well, tell me about what you guys have to offer. That'll come naturally. I want to make sure you understand the space before we go too much farther into the conversation.
Do you think just, I guess, a follow up to that? Do you think there's others in the market who can be doing a little more on the education part?
I mean, I can tell you StepStone is not original in the sense of we're trying to educate advisors. I know many are, and it's really about educating not only the advisor but their client and meeting them where they are comfortable hearing it, and that's over different mediums like the one that we're communicating right now in the form of a
Yep.
podcast. Uh, we came out of COVID and many things changed. And that's not just the fact that you can get groceries without getting out of your car. It's people think all aspects of life should be like Netflix, when they want it, how they want it.
Yep, that's true.
And sometimes communicating with advisors and their clients have to be served in that fashion.
Especially when some of the other options out there, obviously non-private credit options, make it feel as if it's so simple here. I can do a trade, I can do this, I can do that, and I can have my money in my bank account in 12 seconds.
Right.
But it doesn't necessarily work like that with everything else. So, like you've said, it certainly comes down to education. Um, a few fun questions before we wrap up here. A favorite sports team and or hobby?
Ooh, I have to say the Patriots.
Well, now I'm not sure if we can be friends. I'm a Bills fan, so certainly a rival there.
I would say our kryptonite, but it's been a great rivalry.
Um, one surprising thing about yourself.
Um, well, in terms of how we're talking today, I'm 6'4". Most people don't get that over Zoom. Uh,
That certainly is true.
no, kidding aside, I like to bike ride, road, mountain. More recently, I've even taken up a snow bike.
One book that you would recommend reading.
Ooh. So a recent book that I read that was very interesting was titled 1929. I don't think I need to explain what it was about,
No.
but there's a lot more to the story than I think anyone fully appreciates and how we got to the events of 1929.
Most exciting part of your job.
Every conversation I have is different because there's no one way to help clients. And, as a result of that, I've sat down with advisors and clients in 45 states. I tell people all the time I've had the pleasure of seeing this country on corporate America.
And then final question, one prediction for the next 12 months.
I think you'll continue to see private wealth, private markets exposure grow despite the headlines.
I think that's a perfect way to end it, David. Thank you very much for your time. I really much greatly appreciate it. Continued success to you guys over at StepStone, and hopefully we'll get you back sometime in the future.
Todd, thank you. I've enjoyed our conversation.
Thank you. Thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.